this is Oliver Caminos, broker of St. Germain Properties. Are we headed towards a recession? So in many economic circles, stock pickers, interest rate prognosticators, they look towards the inversion of the yield curve as an indicator for a recession during the next 12 to 18 months. So the first question you might be asking yourself is, what the hell is an inverted yield curve? Well, simply put, long-term interest rates, usually the 10-year bond, are naturally higher than short-term interest rate reflected in the 2-year bond. So an inverted yield curve is when that short-term rate becomes higher than the long-term rate. So the last few months we've been seeing the 10-year and the 2-year, that spread between them has been narrowing. And if we follow that trajectory in the next few months, the yield curve will invert, and that'll be the signal for a recession in the next 12 to 18 months. Now, I'm going to show you a graph here. If you look at the graph below, you'll see that the last 7 recessions have been indicated by an inverted yield curve. So this is some pretty accurate stuff. So the second question is, how did we get here? Well, in 2018, I released a video. The yield curve actually temporarily inverted in 2018, late 2018. And then all of a sudden, COVID hit. And the government started pumping tons of money into the economy, tons of stimulus, artificially lowering interest rates. So we kind of kicked the proverbial can down the road. Well, here we are down the road. So now the problem is inflation. So inflation is getting out of hand. And how does the Fed handle inflation? Well, they raise short-term interest rates. That's reflected in the 2-year bond. So that's what, again, is what's going to cause it to invert. The government has already started increasing short-term rates. Now, I'm of the belief that the inverted yield curve is not so much an indicator, but it's actually the cause. It's human error. So if you look back at the Fed, we give our Fed members from Greenspan, Volcker back in the day, Yellen, we give them way too much credit. Through the lens of history, they've made some of the worst financial decisions. Look at the housing crisis. Look at where we are today. The Fed has been really responsible. I don't care what political party you are, they've all been bad, in my opinion. So here we are today. So kind of, I look at the US economy like you're steering the largest ocean vessel in the world. So if you've ever been on a cruise ship or seen the movie Titanic, it takes forever to make a turn. You might turn the wheel, but you'll be turning like a mile down the road. It's not like you're driving a john boat. If you don't know what a john boat is, you need to get some Southern friends. A john boat's a little tiny boat that you can just turn on a dime. So what the Fed does is it keeps raising, not realize that those results are going to be way down the road, and that shocks the economy into recession. These recessions usually last 1 to 3 years. So what does this have to do with the housing market? Well, it actually presents a pretty interesting picture for the housing market. So I think sometime in the next, maybe this late fall, early spring, we'll see a cooling of the housing market. I don't think we're going to see prices go down because inflation is so high, but we might see a stagnation in home values. And that stagnation might be around short term, 2-3 years. And that presents a good opportunity to get out of this market. If, let's say, you're moving to Jacksonville, Florida, or you've had a vacation home here that you don't use very often, it does create a good exit point because you might be coming close to the peak of the market. It's also a great entry point if you're buying into this market. Why do I say that? Because during inflationary cycles, look back to the 70s, real estate usually just keeps pace with rampant inflation, as do other commodities like gold. So although we might see a pause for a year to 3 years in value, in the long term, I think we're going to see a significant increase in prices. You know, your $1 million home now, I'm not saying a year, but maybe in 10 years, could be $2-3 million. Then again, a $3 loaf of bread might be $10. It's not that the bread is gaining in value or the home is gaining in value. It's that the dollar is losing its value. That's always important to remember. So real estate and other hard assets in inflationary recessions like the 70s and other recessions have seen a lot of appreciation. So That's how I see it. That's how I call it. Let me know your opinions. If you have another topic you'd like me to discuss, send me a PM. We'd be glad to do that. Bye-bye.